Hello friends, welcome. Friends, we all know the Reserve Bank of India has made a very important announcement in the month of February, which is 7th February 2025. And what is it? It has driven our policy rate, interest rates down by 25 basis points. So if you look at the RBI's governor's statement, here in serial number 7, it says that the repo rate has been driven by 25 basis points from 6.5 to 6.2, from 6.5 to 6.25. Now, this is a significant event because the policy rates were held very high to 6.5 for a significant duration of time, and for the first time after a long period, it has been reduced, which gives a tendency, which gives an indication that the market is going to be seeded with more money and the funds are going to be becoming a little cheaper. That's the whole idea. Because if the funds become cheaper, then what happens is that the commercial activity gets a trigger, right? So, loans will become cheaper. They will basically get more loans from the bank, and then the money is going to flow in the businesses, and business is going to become more, they are going to basically get triggered, and therefore they will generate more output, and the process, the inflation is going to get contained, and more jobs are going to get created, right? That was the whole idea. Now, friends, why I am doing this video today? I am actually doing this video for a different purpose. If you look at the RBI's governor's statement, it contains a very important point, which is point number 5. And this particular point kind of draws attention to the fact that why rupee is depreciating and what kind of problems that Indian economy is facing. Because friends, what is the problem that we have in our hand to contain inflation? Because if the inflation goes out of control, then we will have a huge problem in managing our economy. Why? Because inflation is the anchor point in which the sentiments of the businesses and the consumers rest. If inflation is contained, then people will have more confidence in the economy. They will make more investments. The economy is going to stabilize, and we will be able to drive towards a better GDP growth, and there will be less outflow as far as government's interest payments are concerned. That also is going to be linked, because as the inflation goes down, the rates are going to be reduced. When the rates are reduced, then there is a direct bearing on the interest payment which the government makes, which is a significant part of the overall budget, right? Now, friends, the challenge that we are facing is that we are importing inflation now. Why we are importing inflation? Because the rupee is getting dearer compared to dollar. More the rupee rate, more the rupee devalues, our exports are going to become dearer from the point of view of rupee. Because we are buying commodities from outside in dollar, in foreign exchange, but when it gets converted in India, we have to shell more rupees. Therefore, there is a likelihood of inflation, which is what we are trying to control, going out of hand because of this imported inflation. Now, if you look at this point, which the Reserve Bank of India has mentioned, this gives us an indication as to what kind of geopolitical, geo-economical situation that we are facing, which is beyond our control. This is the reason why there is a lot of impact which is happening on India, where India doesn't have anything to do, right? So what is that? So let's read this para. It's saying that with receding expectation and size and pace of rate cuts in US dollar has strengthened and the bond yields have hardened. Emerging market economies, that is EMEs, have witnessed large capital outflow, leading to sharp depreciation of their currencies and tightening of financial condition. Divergent trajectory of monetary policy across advanced economies, lingering geopolitical tension, elevated trade policy uncertainties, and it have exacerbated financial market volatility. Now, this is just, I'm reading it to kind of lay the foundation for this analysis and for this video. I'll take you through one by one and explain to you using data as to how to look at this paragraph, which is extremely important. Because if we are not able to contain this, and if we continue to go spiral bound in a different direction, we are going to face a lot of pressure in our economy. RBI will not have the leverage to reduce rate further. Let me explain why. So here, if you look at this chart, which I have created and I have put it in my website, this chart actually compares the US bond rates, policy rates and inflation. So there are three sections of this chart. I have an Indian version also. So this section has got US inflation. This is the US policy rates and these are the bond yields. From this particular section is the bond yields from 6 months to 30 year, right? Now friends, why I have plotted this, three different dimensions, vertically, because it kind of gives you a very good flavor as to what is going on. Now let's look at the 10-year bond rate. Now why 10-year bond rate? Because 10-year bond rate gives us a metric to measure expected inflation. Because expected inflation is what drives the real inflation. Because if people are expecting a higher inflation in future, then what will happen is that their behavior is going to change and the businesses are going to basically demand more prices from the goods. Laborers who are working in those businesses is going to demand more salary. So it kind of becomes spiral bound and it also drives your real inflation. That is why expected inflation is very, very important to manage. And that is the reason why RBI keeps policy rate high, because policy rate is an indication that you contain liquidity. You would let the businesses know that the real inflation is going down, because as the liquidity is curtailed, the real inflation goes down, and in the process the expected inflation also goes down, which actually has a positive impact on the real inflation. So it's a positive feedback. It drives the inflation further down. Now, why expected inflation is a measure of a 10-year bond yield? Why it is like that? It is because of the fact that whenever you are investing in a long-term bond, and if you are going to when you are expecting a certain yield, and if that yield is going to be lower than your expected inflation, then why would you make an investment for the first place? And therefore, the overall market visualizes certain amount of inflation in the future. And based on that inflation, the price of the 10-year bond rate is decided. That's how it actually happens. And therefore, you will find very strange that before January 2025, if you look at January 2025 here, right, here the 10-year bond rate number has shot up to 4.62% in US. And in all the years below that, the number was kind of going down. It actually has started shooting up from September onwards. You see, it's a very important milestone to note. September onwards, this is the date. Just keep a note of this particular date. September 2024, you will find that the 10-year bond rate have suddenly shot up, and this is the marker on which the rupee has started depreciating. That is what I wanted to show you in this video. Because let me do a zoom in so that you can basically see what I'm talking about, right? Look at this marker, September 2024, right? Where the US CPI inflation was 2.41 and here the 10-year bond rate was 3.99, and then it basically went 3.9 and then suddenly it started shooting up from 4.2, now it is 4.62. This is exactly what the RBI governor is saying from the point of view of bond yields have hardened. You do understand now? Now, what happens when the bond yields are hardened? What does it mean? It basically means that people who have invested in India, those foreigners who have invested in India, they will take their money out from India and start investing in US bonds, thinking that they are going to get a better yield. You got it? So this is why, the Indian rupee is depreciating. And since I told you, just mark this date, September 24, and I'm going to show you another chart which is going to give you a very good flavor as to what happened to rupee, right? And if you look at this particular month, look at September 2024, and this chart is the daily exchange rate of Indian rupee. So I have taken a monthly time scale, and you can see that from September 2024, which rupee was stable, 83.79, and suddenly from September 2024, you see an exponential decrease in the value of rupee, which kind of coincides with the US 10-year bond rate right here. Can you see this? Exponential increase in yield of US bond rate. And that is what the RBI governor is saying. So our rupee depreciation is directly linked with the US economy and economy bond rate. Now, why is US bond rate suddenly has went spiral bound, went out of control? Because earlier the Fed chairman, right? If you look at the Fed chairman, had given an indication that the market is going to stabilize, the bond rates are going to stabilize, and he's going to do a four cuts of the US policy rate in this particular financial year or the calendar year. Now, looks like that's not going to happen. And that's not going to happen, and that is why these bond rates have this, because of this bond rates going higher. So if there are not going to be any further cut, because he's not going to cut the bond rates, because he's not going to cut policy rates, because he wants the bond rates to go down so as to contain real inflation. That is what the Fed's job is. Now, if Fed is not able to contain real inflation, then what will happen? The things are going to go out of control. American economy is going to collapse. Now, the problem, friends, is that Donald Trump coming into power has further disturbed the political and the economic dimensions of US because of this threat of tariffs. Because Donald Trump is going around giving this threat of tariff to all the nations, right, including India, then what does it mean? It basically means that the US consumers, goods and commodities are also going to become dearer because most of American goods are imported from outside. So if you put a higher tariff, then the tariff is going to be passed on to the consumer. So because of this political change that has happened in US, I don't know how it's going to play out. It has disturbed our economy, Indian economy, and the direct impact has been the rupee to US dollar rate, and which is creating an havoc. And let me tell you, friend, this is extremely risky situation as far as India is concerned, because our inflation is already very high. We are not within the window period of 2 to 4% of RBI. And if the dollar value keeps on appreciating like that, then our imports from a rupee point of view is going to become very, very dearer. And that is going to further, fuel the inflation, because it is going to import inflation from outside. Because more the commodities that you are buying from outside, like fuel, etc., for which you have to shell out larger rupee. Therefore, what will happen? Indians will also have to shell out larger rupee, because to make sure that you are able to pay for those imports, right? So this is a very, very, delicate situation, and that's why I thought to explain to you using the charts which I have created, because unless you have these charts right in front of you, you really cannot make out what is going on, because it's all speculative, because RBI governors know, because these people are smart people, they have all the data with them, right? So they know, and this is why this particular point is so important. Point number 5, in this whole policy statement, I think the most important we have to focus on is this. Because if we are not able to contain fall of rupee on a continuous basis, and the US economy's bond continues to keep on strengthening going forward, friends, we are actually going to see a very large fall of rupee going forward. Rupee you can't contain, because how much foreign exchange that you will be able to spend to contain rupee? You can't. You look at what is happening is that our foreign exchange reserve was in the week of 25th October 2024 was 684, and now it has fallen to 630, right? And if I do a monthly time scale, you will see that exactly from the month of September, which I told you. You see, you have to note the time frame of September, right? Look at September, from where the bonds actually went haywire. Look at this particular day. From here, the bonds basically started escalating, and exactly this is the time when the foreign exchange also started dropping. You see all the coincidence of that is why these charts are so useful, because you can correlate with each other. You can actually tell the story by looking at this number. There is no point of any conjecture. It's all there right in front of you. So this is exactly what I wanted to do in this video, to tell you that what is going on, right, in the economy, and what kind of risk that we are facing. There are various other aspects of the dimension. This is not the point about this video, because those are different. We'll cover those separately. But this story was important for me to tell by showing you this data, because this data is extremely important. And that tells us the real story, and we have to keep watching this US bond yields, right? This number. By the way, friends, one caveat, this January inflation number of 2.82 of US is a made up number because the numbers are not yet out. But in order to basically create a synergy between all the three charts, I just put a placeholder here. That's what I want to say. Just don't look at this 2.82%. Actually, the real numbers are 2.9, which was announced last month in the same time period of December 2024 inflation. So January number of US inflation is not out. So friends, thanks for your time. I'll stop here. I hope that you have liked this video, and you can get access to all this chart right there in my website, and you can look at it for yourself if you're interested. And anyway, thanks for watching till the end. I'll come back with a new video next time.